Well, for more on trading matters, though, specifically back on equities, Chris Conway from the Australian Stock Report is in our Melbourne studio. Chris, welcome to you. 50.56, the figure as we sit here now. You are calling out, though, the logical next move, unfortunately, being south of that. What are you predicating it on, and particularly in light of this firming data from China?
Good morning, Carson. Firstly, to the latter part of your question, the data out of China. I'm certainly not as bullish as your previous guest. It's one number in a data series that remains below trend. We know the number below 50 means it's still in contractionary territory. It's a nice beat today. We'll probably get a bit of a rally, but I certainly still think the market is headed lower. First of all, from the technical perspective, it's a measured move from the descending triangle pattern that we saw form on the XJO recently. But more than that, you know, it's the Australian economy, it's the global economy, it's the continued rates lift-off agony coming out of the US, it's the global growth concerns. It's really sentiment on the back of all those things. I can't see where investors are going to get the inspiration to be buying stocks in this market yet. And throw into the mix as well that the Australian market, from a forward PE perspective, still doesn't look all that cheap. It's fallen from about 16.2 in February back into 14.5 where we are currently. The 2003 forward average is about 13. So it's still not all that cheap. And like I said, on the back of the sentiment and the factors that I mentioned previously, I don't think investors are in a big hurry to get back into this market just yet. So 4,700, I think that's the point at which we could move, as I said, technically on the back of some sentiment. And then when we do get there, I think the market does look a bit more compelling from that forward PE perspective.
What do you think might drive us there? What could be the kind of straw that breaks the camel's back?
Well, it's not necessarily a straw that has to break the camel's back. I mean, it's only... All right, we've bounced a bit today. I think you said the market's at 50.50, so we're, you know, 350 points away. It's not that much further to fall. It would put us in bear market territory, though, from the 6,000 point high. Of course, it would be almost a perfect 20% or probably 22% by the time we get to 4,700. So, yeah, I don't think there's any straw that needs to break the camel's back. I think it just needs to be more of the same. You know, even local data. Clearly, there's the housing market is starting to cool. We saw some softer numbers yesterday in terms of approvals, and then again some softer or slowing numbers today. So there's a whole lot of factors that go into the pie, and none of them. I mean, I just can't see, like I said, where I think investors are going to get the impetus from to start buying this market again because it just isn't that cheap.
Yeah, you are making distinctions between investors and traders, which, if you're in the latter camp, you're saying run a short bias portfolio. Relatively simple.
Yeah, absolutely right. Run a short bias portfolio. At the moment, we're advising our clients that anywhere between 2/3 and 3/4 of your positions should be on the short side of the market, and of course you have some long positions with the remaining area of your portfolio to cover in case the market does rally. Again, it's more of the same. I've been calling this market short all the way down. The third test of 6,000 earlier this year, I said we're probably 5 to 10% above where we should be. Got to 5,400. The next logical point of call was 5,000. We got there. It was breached, all being fleetingly. The next point of call is 4,700. So yeah, there's no need to change the game at the moment or change what you've been doing. Stay short if you're a trader until the market gives you enough evidence otherwise to suggest that we're going to get a sustained move higher. And as I said, I don't see where that is going to come from. Maybe I'm being too bearish, Carson. Maybe you've got something up your sleeve that you can throw at me that suggests that we're going to rally.
Fear not. I'm being accused of being a perma-bear even as we speak by some. So it's called taking a contrarian position for necessary reasons. Otherwise, you just go along with herd mentality. The bad debt cycle seems to have bottomed. That is a bold call. You're calling out on CBA 63 a piece.
Yeah, I think the bad debt cycle has bottomed. The bad debt is very low at the moment. You know, it's at sort of almost record lows. I don't see it getting any better. It's probably going to deteriorate. Loans in arrears are starting to rise, and I think we're also at the top of the credit cycle as well. And again, some of the recent housing data suggests that that's the case.
Because it's interesting, PIMCO's calling out 2 more rate cuts, so they're kind of lending some support now to the ANZ call from last week. From what you're saying, the banks won't pony up with any pass-through?
Yeah, I certainly don't think they will pony up. They won't follow through with the whole rate cut if indeed we get one further. We've already seen the investing market start to tighten because banks have raised the rates to investors. So yeah, I agree with you. I don't think that the banks will pass it on. I think that market will continue to deteriorate, and I think that is bad news for the banks. CBA is the one that we're short at the moment. We've got a price target into 65, and we think, yeah, it'll probably get there. Well, maybe not before the end of the year, but certainly into early next year.
G8, you've let your guard down when it comes to personal views as far as allowing them to cloud perhaps judgment, but you say this one was a lemon from day one. Why so?
Not quite a lemon from day one. I just don't think it was the market darling that everyone had it cracked up to be. And fortunately, to this point, I've been proven right. It topped out at 560 earlier in the year and has headed south, or sorry, sort of halfway through last year, and has just headed south since. I never liked the model. I always thought they were paying too much for their acquisitions. And some of the synergies that were talked up, I just don't think they were. I don't think they were real, to be perfectly honest.
So what did you like about it?
Forget.
What did you like about it?
I didn't like anything about it.
So it was effectively a lemon.
Well, yeah, as it currently stands. Well, it was a lemon in the sense that people were bidding it up too much and paying too much for it. The business isn't a complete dud. It can make money. It certainly never deserved the multiples that it got to. And that's, like I said, on the back of the synergies that were talked up. I mean, let's not forget that childcare is regulated. You have to have a certain number of people looking after a certain number of kids. So whether you know how to run one childcare centre or 1,000 effectively, well, it doesn't matter because your costs are going to be the same. So I just didn't see...
Well, 293 is where it's at. V524 back in October last year. Effectively, almost on the anniversary as we sit here today. It was the 3rd. We're not there yet, but that's the time frame. Effectively, more than halving in value. Is this the fair value story now at these levels?
No, I don't think so. I think it's still got further to go. I reckon 250 is probably the target for G8. Yep.
Okay. Well, that's good to get that call out. And from that, we will thank you, Chris. Talk to you soon.
Thanks, Carson.
There we have it. Chris Conway coming to you from the Australian Stock Report in Melbourne.